Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today is Wednesday, October 18th. This is host Richard Benuli. Today we have Dr. Marc Faber and Ira Harris. Dr. Faber is the editor and publisher of the Gloom, Boom, and Doom report, website gloomboomdoom.com, which highlights unusual investment opportunities. It's a great publication. I'm a subscriber myself and learn immensely from the insights of Dr. Faber. And Dr. Faber is also the author of several books and well known for his contrarian investment approach. Ira is a hedge fund manager, global trader in foreign currencies, bonds, and commodities and equities for over 40 years. He has served as CME director from 1997 to 2003 and also a stint most recently. Welcome, gentlemen.
Well, thank you very much for having us.
Yes, thank you, Richard. It's not an easy time, but let's have a go at it, I think.
Yeah, great. I thought we'd begin with a question, Dr. Faber, on your global macro view on the economy and the financial markets.
Well, I travel again more often than before. During COVID, I didn't travel. And I go out here in Thailand, so I have an idea about the economy of ordinary people. I also read a lot of statistics about the US and about Europe and so forth. What strikes me is that governments keep on telling us that the economy is expanding, that GDP growth is this and that. But the reality is that for most people, I'm not saying for everyone, and I'll explain in a second why, but for most people, their salaries have gone up less than their cost of living. I mean, in Switzerland, the official rate of inflation that the government is publishing is 1.9%. The 10 years treasury bond in Switzerland, the Bundesanleihe or Staatsanleihe, is at 1.1%. In other words, even from the government misleading published statistics, the bond yield would still be lower than the rate of inflation. But the reality is that inflation in Switzerland must be around 3 to 5% per annum and not the 1.9% that the government is publishing. And the salaries are going up less than the cost of living. This is very obvious when you go out in high-end restaurants near the center of the city. It's still a booming economy because money hasn't really become tight. Interest rates are up, but the level of interest rates doesn't tell you whether money's tight or not. I mean, in Argentina, you have interest rates above 100%, and inflation is also above 100%, so money isn't tight. The symptom of tight money is when bond spreads shoot up against treasuries. In other words, this hasn't happened yet. And a symptom of tight money is when asset markets collapse. But if you look at, say, the 70s, throughout the 70s, interest rates went up, and they went up a lot from, say, 6% in 1970 on the 10 years treasury to over 15% in 1981. During that period of time, money never really became very tight because inflation accelerated. So we are in a similar situation. I don't think that money is that tight at the present time. It's maybe tighter than before. That's why stock markets don't go up anymore. But as long as the price of gold and precious metals and oil go up, money isn't truly tight. This is the fact. And I think that for the typical household in the world, the living conditions are going down. That's why we have also a lot of social problems in the world and geopolitical problems. But that is one thing. The other thing are financial markets. And there I have to say, because money isn't tight, there are still opportunities. And I'd just like to summarize something that I was just writing about. At the end of 2021, one stock market that was incredibly depressed was Turkey. What happened? In 2022, it went up by 100%, plus minus in US dollars. I adjust everything for the US dollar. And at the end of 2022, what was very depressed was the Iraqi stock market. What happened? It went up by 90% now, 79% in just 9 months. So there are always opportunities in a world where there is still plenty of liquidity. Now, we need to find out what is depressed at the present time and what can go up over the next 12 months. And given all the factors that I already mentioned, geopolitical factors, economic factors, monetary factors, the money is not really tight. I think that precious metals have actually a brilliant future ahead of themselves over the next 12 months, including mining shares, which are very depressed compared to, say, the price of gold. So I think there are opportunities, but we also have to acknowledge that some stocks in the world are terribly expensive, namely the FANG-related stocks and AI stocks like NVIDIA and so forth. And this group and stocks I would avoid. So we could have an environment, and Leon Cooperman was recently interviewed, and he said, I'm not interested in the S&P 500. Like in the 70s, I'm interested in individual stocks and individual sectors. And I think I feel the same way, that we can make some money in the individual sectors. But the money kind of bonanza, the casino that we had between 1982 and 2021, where everything went up, this is over for good, because we are in a rising interest rate structure, and interest rates cannot go down meaningfully as long as you have governments that are the worst bureaucrats I have ever heard of or lived with in the last 70 years of my life. And the Treasury Secretary in the US is the worst Treasury Secretary you could ever find anywhere in the world. When she goes and states, we have money to wage 2 wars. Yes, you have money to wage 100 wars if you print money, correct? But it doesn't satisfy bondholders much. And it shows the lack of fiscal and monetary discipline that exists in the US, which will eventually haunt the US very badly. So sorry to have taken too much of your time.
Oh, that's good. Yeah, very insightful comments. Your thoughts, Ira?
First of all, Dr. Faber, you can never take too much of our time.
Right.
But I'm going to ask you, because you made a very important point about rates and tight money, and what's that determination? I mean, we've looked at this inverted yield curve, right, for quite a long time. Now we are at a period, and I'm going back to the statement that you made. So money is not tight, and I agree with you wholeheartedly. I think money is, we saw some tightness in money. Gold, for those who are in a very leveraged position, realize that when we did get to at least a positive real yield on short-term money, which I believe is far more important than on the long end, because that'll always normalize itself at some point if you have good policy. But when you talk about the metals, and I've been amazed that, yes, we had a correction, a very sizable correction in the gold, especially you could really time it to the rollover in the paper gold, as they say, at the COMEX and other exchanges. When you rolled from the August contract to December, and the cost of that roll was you had to pay a premium if you used that as your way to position in the gold market. You had to pay a premium to go from August gold to December gold of $45, which is really the efficiency of the market, because that's the cost of borrowing to buy the asset, which is what you do basically when you buy futures contracts. So the market was very efficient in pricing that. And I think it caused people to stop and go, wait a minute, I have to pay basically 5.5% to own that money? Well, then all of a sudden people started getting nervous because that was a huge premium, and they actually realized what the cost that was. We corrected, and now we reverse quite a bit. We're almost back to the, in fact, I think we actually made new highs from that. No, not quite there this morning, but it is interesting to me. And you bring that up, and gold, phenomenally so, really holds in exceedingly well. I mean, if you had told me that we would go to at least zero real yields and maybe positive real yields, and gold would still be trading at 1900, 1920, whatever the number is, I would say no, not a possible way in the world, but yet it does. And that should be really worrying people. But I think it does it because the last point that you made about when I saw her comments over the last 2 days, Janet Yellen, and I used to have a respect for Janet Yellen, but she is I think she's a very bright woman, a terrible politician, because she's just not a good liar. And when she gets caught in her own trap, because as a politician, we know you have to lie. It should, some have more credibility in their lies than others, but she's losing her credibility each and every day. But it still comes back to this issue of yield curves. And as you say, money can't possibly be really tight, because I agree with you. The stock markets have held up unbelievably well. But then it makes me wonder, are people hiding in the stock markets as the haven? Because there was a piece the other day from Mohammed Al-Arian, but more importantly, Liz McCormick at Bloomberg had a piece over the weekend in which he had actually interviewed and talked to one of my favorite bond analysts over the last 45 years, Lacey Hunt. And Lacey Hunt said he's been so humbled by this because of all his work. And I know that because I've talked to Lacey through Richard. So it's been a while. But him and David Rosenberg have been looking for a bond rally based on what they perceived was going to be a massive slowdown in the global economy. And I think a massive slowdown doesn't actually get you a bond rally anymore anyway, because the cost of carrying this debt is phenomenal. And we've already, the CBO, as usual, been dead wrong. The numbers are there. And the cost of financing the deficit, I believe, has now exceeded the defense budget. So your point is, yeah, you can fight all the wars you want with a printing press, but that ain't going to help. And I think that people running in and buying dollars, I've read some people's analysis of it. It's very hard for me. I can trade the long side of the dollar, but I can't get convinced of the dollar because of the massive deficit, and the funding of that deficit just cannot be good for this country. And there was that great piece written by Charles Cal Morris out of the St. Louis Fed, in which he discussed, I think it was back in April or May, he discussed the coming issue of fiscal dominance, where fiscal dominance will be. And I think this is what a lot of bond bulls have failed to understand. Fiscal dominance is a major, major issue going forward. And I'll stop there. I've said enough.
Yes, I mean, you ask a question about the bonds. And I think, you know, the bonds, they are, you know, they are, 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 I'd just like to give you an example. In 1969 already, inflation in the US was around 6%, okay? And the 10 years bond yield topped out at 9.19%. 9.19%, given the inflation at the time, 1969, of 6%. And now we have inflation, okay, it's come down a bit, but say at the peak, a few months ago, it was already, it was also around 6%. And I would argue that if inflation, the cost of living increases, were properly measured with the increase in the cost of fees that you have to pay to the government and to healthcare expenditures and insurance money and housing cost, and that inflation is also around 6%. And where are the 10-year bonds? Not even at 5%. So what you said, that even if weakness occurs, we shouldn't expect a huge rally in bonds. Now, there will be probably a rally in bonds because the fund managers in institutions, they're as brain damaged as the bureaucrats. You understand? They're not much better than Yellen. And I disagree with you vastly about her being intelligent and smart. But this is not the subject of discussion at the present time. The fact is simply the governments of Western democracies, they are sort of forced to print money. They cannot implement the monetary policies of Paul Volcker in 1979. I mean, you have to see, Paul Volcker had to push up interest rates to close to 20% to kill inflation. That is the killer of inflation. You have to hit the fist like Mike Tyson, unexpected blow. You can't increase interest rates slowly, because I could argue people like myself who have funds, I'm better off this year than I was last year because I have now 5% interest income, whereas the last 3 years I had no interest income to speak of. So a lot of people actually benefit from this increase in interest rates. The rich people benefit, and the poor people, they are hurt, because the poor people, they have borrowings, they have credit card debts, they have student debts, they have every sort of debts. And of course, the US government is a large borrower of money. And so they will continue to cheat about the true rate of inflation, because if they publish the true rate of inflation, they would have to pay much more interest on the government debt. It's gone up a lot already, but it may go up much more. And then money printing will become a necessity. There's no other way except default or a sharp increase in taxes. But the poor people cannot pay much more tax. And the rich people, they control the government, and they always have loopholes about paying taxes.
So, Richard, I don't know where you're going, but yeah, I Dr. Faber, and this is, you explain to people that yes, but on the other hand, as you beautifully state, for 12, 13 years, we were being financially repressed by the world's central banks. Now they're paying interest. And yes, this has been, I'm earning, I don't have to be in the stock market to the extent that I was. I've rolled back plenty of my holdings, but like you, I can look for individual stocks, and I have to go back to the last time we were on together, which has been far too long, but a lot of the stocks we talked about for that same reason were really good stocks. We talked about agricultural stocks. Bunge has been a star performer, and I know we both loved Bunge. We talked about some banks in Asia which I think have done very well. I still look for the Japanese banks to be a pretty good performer. And as owning Mitsubishi Tokyo through bad times still was like owning a bond because it was paying you a 4% dividend. Now the Japanese economy is far more interesting than it's been to me in a long time. And they're moving into the defense sector, which they can gear up far faster than probably any other country outside Germany. And the stupid United States is pushing them to be more self-reliant on defense, which is only going to create a very great competitor to the U.S. defense industries. To me, no question. And you couple that with a very undervalued yen. So we have all these things. But going back to the main concept is that the government paying out all this interest. I would say to people, if I go back to 2021, on $1 million T-bill, I was earning a 1-year T-bill at a yield of $1 million, you maybe earned $4,000. Now that same $1 million T-bill is $55,000. Somebody's paying it. And I know who's paying it. So you can do the math. And Janet Yellen, you may think you can finance two wars, but you can't finance 2 wars and pay 6% interest on the $900 billion in T-bills that you're going to issue in the next quarter. It becomes, the math doesn't work.
In the long run, the math doesn't work, especially not regarding the unfunded liabilities. That is another subject.
Yeah.
So my conclusion is that basically the governments in the Western world, they may talk about, combating inflation and trying to bring down the rate of inflation. But I think if we look at long-term cycles, and actually Neil Ferguson had a very interesting article about the end of the Volcker area, which he defines as 1980 to say August, May 2020, falling interest rates. This is over. We are now in an environment, and I just published a report with a chart of the various inflation waves in the 70s. Inflation accelerates, then cools down, then goes up again, and so forth. And I would expect the same to happen now, especially under the conditions or under the geopolitical conditions we have at the present time. But as I said, in an environment such as we have, I also enjoy 5% interest on deposits. But I have to say, when I grew up in the 50s, my grandmother always said, you have to save 10% of your income and put it in a bank on deposit. This is the safest. And at the time, it was safe. But nowadays, nothing is safe. That is the conclusion that I have about the current environment. And relatively safe, but the government can also take it away, especially you in Canada. Look at what kind of a prime minister you have. Yeah, I mean, it's hard to believe that in a democracy, the people would vote for just about the worst leader. I'm studying now, once again in my life, Roman history. They have some emperors that are really the worst. But nothing, even the worst in Rome is better than what you have in Canada. It's hard to believe. Yeah. Complete morons in Rome were more desirable emperors than what you have in Canada. And right. He behaves like an emperor. That is the best joke. And so anyway, but nothing is safe. And the government, of course, can take away one day your property, your house, your car, and your gold. And so you have to hide it and have it in different places. And also, I was just giving a presentation to some people. If you have a kilobar of gold, first of all, if I had to travel somewhere else, and I would certainly not travel to the US with a kilo of gold or 5 or 10 kilos of gold, because the immigration officer would right away arrest you as a money dealer or launderer of money or drug dealer or whatever. I would go somewhere else. But it's difficult to carry. And in a truly emergency situation, they will switch off the water and they will switch off the electricity, and the credit cards will not work. So you need to have something to pay to buy, say, cigarettes. Now, in emergency situations, cigarettes become money. So you should store a few 1,000 packs of cigarettes. And at the same time, if you go to a shop, they cannot change money for a kilogram of gold. You would need to go there with, say, coins of 2 or 3 grams, to buy small grocery items. And therefore, I recommend people to have different diversification in gold. Some, an investment, okay? And that investment you may keep somewhere, either in the country you live, some of it, and then in a country that you perceive to be desirable. I perceive Singapore to be relatively desirable, and Switzerland also, because we have reasonably good property rights in Switzerland. But it's, again, not 100% safe, because we have now more and more socialists. The socialists have always and repeatedly in history only destroyed wealth. They never created anything that is meaningful. That I would remind your listeners. But so the diversification of where you hold your assets is important, and you should have gold in small denominations so you can go shopping when everything fails, when there's no light and when there's no electricity and no water and nothing.
And you just mentioned earlier on the geopolitical situation, a very sad situation on the geopolitical aspects of the world. How could that affect the global economy and the financial markets? In the past, also, you've mentioned the World War III investment scenario as a case for investing in especially Latin American equities like in Brazil, Argentina, Colombia. Do you still see that as playing out, or do you see that as playing out now?
Well, I mean, every idiot has his luck. I was lucky to invest in Petrobras, and since in the last few months, it's gone up 50%. And also in Argentina, Telecom Argentina has gone up strongly, and so forth. So there are stocks that did well in Argentina. Even in Colombia, some stocks have done okay. I'm now also interested in Pakistan, because Pakistan stocks are very cheap. And there is a Pakistan ETF that you could buy. But yes, I still like Latin America, and I still think that food will become an important factor in the lives of people, because if the current wars in Ukraine and in the Middle East, in Israel and Gaza Strip, are enlarged, then who knows what will happen? Because, I've written recently about BRICS countries. They're not a political union yet, because you have China and India, and they have vastly different objectives. But it is a reaction to the arrogance of the Western world to dictate the third world or the rising world what to do. I mean, when Liz Truss was, before she was Prime Minister of Britain, she was the Foreign Secretary. And she went to India and lectured Indians how they should react and be on the world scene. And India, accidentally or coincidentally, has now just overtaken Britain as the 5th largest economy in the world. Then if you're the leader of India with 1.3 billion people, and you have a Liz Truss come to you and kind of tell you what to do, you scratch your head and think, is she not very well in her head? You understand? This is a different world we're dealing with than in the past. We're no longer dealing with China where when the Chinese burned down the opium at the factories in Canton, in Guangzhou, Britain sent the soldiers and then extracted ransom and took Hong Kong away from the Chinese. I mean, these days are finished. This is a different world. The only people that think it's the same world are morons like also this Macron in France, who thinks he can go to Africa and tell the Africans what to do. They're not going to listen to him. They're going to kick him out, and that's precisely what they've done. But don't you agree, Ira, is a different world?
Dr. Faber, see, we're so simpatico, and we've talked about this, because we read Burdell, and I read Arrighi, and I understand the arrogance of Western thinkers. And I'll tell you what, exactly where Dr. Faber leaves off on, Macron needs to go back and read the Bible of those who they're confronting. The Wretched of the Earth is the most important book written about promotion of terrorism. And where does it come at? It came from a Algerian French psychiatrist, Frantz Fanon, who wrote about why terrorism is an acceptable practice in any way, shape, or form. And it's the West doesn't want to believe it because Dr. Faber, to me's point, is dead right on target. We think that everybody believes and looks at the world in which we do. You know, and all you do is have to go back to the works of Tom Friedman and what's the name, who wrote about after the fall of the Berlin Wall, that it was the end of history, right? That was the big thing. The end of history.
Fukuyama.
That's right. And the end of history. The world is flat. We've won. It is such a narrow-minded, and I am so opposed to Western arrogance. You know, I come from a far left background when I learned about debt and currencies back in the 70s. So I've studied this, and I've been abhorred by Western arrogance and it still prevails. And I can't agree with you more. Well, what is the West going to China? What does Yellen go to China? What does Jake Sullivan go to China? What does Blinken? And they lecture the Chinese. They don't pay attention. They don't pay attention
Yes.
to what these people talk about. And where they should be, you know, one of the great hypocrisies of the world is everybody looks at Iran now. Well, Iran, who wants to be the quote unquote great protector of all things Islam, is doing more business with China than anybody else, while the Western media just proclaims how China is oppressing the Uyghurs, right? That's all we heard. That was for 3 years. That's all we heard about. But the great hypocrisy is the guardian, the self-appointed guardian, I stress that, self-appointed guardian of all things Islamic in the world is doing more business with the greatest oppressor of Islamic people. So,
Yes.
you know, you just
Nothing new.
yeah, you just shake your head, and India can fit in there plenty good too. By the way, they have their own problems with the Islamic world, but these things don't go discussed. And again, why? Well, it's not really important. You know, it's only important when we say it's important. It says Dr. Faber really talks about that arrogance, and in that arrogance, of course, provides the opportunities for global investing, which we look to, because those are, I know we're talking about, you asked about geopolitical, Richard, and it's just because that's what we have to look for, is the opportunities that come out of this arrogance, and they are plenty. They're plenty.
Actually, Ira, we shouldn't be talking to each other.
I know, but I had to laugh when you talk about Trudeau, because Canada should be booming right now. They
Yes.
have everything that the world wants and be secured. Energy, they have as much energy as anybody else if they're willing to use it. Precious metals and raw material, minerals, Canada, and the Canadian dollar is 73 cents. That's the greatest. Statement about the ineptness of Trudeau. I don't have to look anything farther. There it lies, and their debt to GDP ratio isn't that bad. It's just poor governance, which has chased more money away. They should be really, and they could be a help to a lot of the world because those are secure and they do have. They seem at most of the time, Dr. Faber, 90% of the time they have great respect for the rule of law. We saw a period where they didn't have such great respect, but we'll get off the geopolitical. Sorry.
Just following up on China, for Western world investors, like from the Five Eyes countries, Dr. Faber, do you think it is safe to invest in equities listed in Hong Kong?
Yes, I think so. And I think Hong Kong shares are incredibly cheap. And we have in Hong Kong an unusual situation in the sense that I moved to Hong Kong in 1973, but in 2000 I moved to the north of Thailand, the Golden Triangle, because I saw the agricultural potential in the north. But I still have an office in Hong Kong and I go there quite frequently. But in the last 50 years that I was in Asia, I've never seen in Hong Kong the mood this negative, where foreigners are selling stocks and locals are not really buying. Normally, when you would see a property company whose assets are 50% or 100% higher than the market value of the stock. In other words, stocks are selling at, say, a 50 to 70% discount to the stated asset value. You would see the families come in and buy back shares. It has happened, but not to a very large extent. I mean, the families in general that control Hong Kong, the old established wealth, in general, they diversify outside Hong Kong. And I have to say, this is a reason the dollar has been relatively firm. You see in Switzerland, if I have a deposit with the bank, they pay me, say, 0.5% interest. Then as a Swiss, I say, I rather have US dollars at 5% deposit rate. And then the young people say, well, in Switzerland, you know, why should we invest in these old companies and traditional companies? We want action. We want something that moves. So they go to the US and they buy meme stocks or SPACs or AMC and GameStop and this type of share. And this year they bought WinFast and Vietnamese battery electric vehicle company, and they built it up to a valuation of like 100 billion. Now it's collapsed by 95%. But you understand the attractiveness of the US, I can see relative to other countries. In Thailand, if I have a bank deposit for 1 year, I get about 2% interest. Now, and we just have a new government, and it's not a very desirable government. So I think that a lot of currencies are even worse than the US dollar, although it's hard to believe, but this is the case. But I think in general, investors should gradually, and I've been advising this for a long time, should diversify it outside the US and not have everything in the US.
Great, interesting. And your thoughts, Ira, on that?
Just very much. Is the dollar is? I hate that phrase. I'm not even going to use it when they talk about the dollars. Yeah, all currencies are always a relative value, but I think, and this is an issue for people who are bullish bonds. If you remain bullish bonds, and that's really a statement about the dollar, by the way, and especially because so much of the U.S. deficit is financed from outside the country. It's not like Japan was. Everybody wants to compare Japan always to the U.S. through the bad years. But at the initial onset of deflation in Japan, and what the policy was, 97% of Japanese debt was owned by domestic investors. So when you have real deflation, which we have not had in the US especially, we have not had real deflation. We've had a lot of discussion about deflation, and we had Bernanke being scared out of his mind about coming deflation because of all his research going back to the 30s, of course, and he feared it, but we've never had deflation. Japan had deflation of 1.5%. And I'm smoothing that out because it was more at sometimes. So if you bought a JGB that yielded at 40 or 50 basis points, you were still getting a real return on your money. If you were a pension fund or insurance company, a private investor, you were still, and it was, again, 97% owned by the Japanese domestics. We have nothing like that in the United States. We depend on all those people who we run current accounts deficits with to reinvest that money in the U.S. Right? China is a huge buyer. Now, not as great as they were, but we don't really know those numbers anyway because they're smart enough to disperse their investments around. You have all these sovereign wealth funds, the Saudis. We can go on and on. The Norwegian, they run massive. And I think that's one of the key things to the global markets now is the massive amount of money that is placed in sovereign wealth funds. And which means, look at what the Swiss have done. Although the Swiss, and I understand why the Swiss franc remains strong because they've shrunk their foreign reserves dramatically, which means that they've been selling equities to buy in. When they do quantitative tightening, they're selling off their huge portfolio of global equities. The S&P, by the end of the day, they'll pin a medal on them because at least they were smart enough to buy something that has better value than bonds, even though they do own a lot of global bonds, but they own a massive amount of equities. So, everything that Dr. Faber said, I agree with totally. The dollar does go up because, again, they're paying a higher rate of interest. But it is, to me, getting to crunch time as we hit that concept of fiscal dominance and where the cost of carrying this debt load. And if we go back to Volcker, I've always, when they said, Jerome Powell's looking for his inner Volcker, Paul Volcker couldn't find his inner Volcker in dealing with a massive deficit of 110% and people carrying so much debt, personal debt. He couldn't have done what he did and inverted the yield curve. The curve inverted to like negative 600 basis points in an effort to squeeze. The deficit, the U.S. debt to GDP ratio at that time was 39%. Had he gone to 18, 19, 20, 21, I think the high on the rate, not the Fed funds rate, but the bank lending rate was 22%, if I remember correctly, because I took out my first mortgage at 12 3/4. But he couldn't do that. He would have brought the world to a depression because nobody could have paid that debt. Especially look at what it did to the quote unquote global. Well, we used to call it the third world, then it was the less developed, and now we call it the global south. But they would never have been able. It was tough enough for them in today's world. Not a chance. The amount of debt is just too. It's too high. It's too high. You can never go there.
But I'm glad, Ira, that you mentioned that you took your first mortgage at 12.4%, because today's generation, they don't know what high interest rates are. They think 4% is high, but it isn't high in the context of what we have seen in the past. And I think the bond market over the next 10, 20 years could easily go and have higher yields than what we saw at the peak in 80, 81. I'm not saying this will happen tomorrow, but as I pointed out to some friends of mine, if you go to Istanbul and you walk around the streets in Istanbul, and Istanbul has an inflation of, Turkey has an inflation of around 100%, everything functions. Everything is okay. So you can have very high inflation rates and the system still works as long as you index everything and you print money and so forth. But obviously the poor people are hurt much more than the wealthy people. And eventually the system breaks down. Eventually, but it can take a long time. That's why I say, when people say the debt is too high. Yes, I agree. I thought already in the 80s the debt was too high. But maybe Ira would remember Charlie Minter and his colleagues at Merrill Lynch. And they always wrote about a debt collapse in the mid-80s, because at the time the deficit was going up substantially. But we're still there, and the system still kind of functions halfway.
Yeah, it's 100% right. Sorry, Richard, you're up.
Oh, no. Good. Yeah. Just respecting your time, Dr. Faber. Last question, if okay, on Africa. You've done some analysis recently on the extent of the increasing trade between Africa and China, especially with respect to the U.S. Just wondering your thoughts on Africa, in investing in Africa, which countries you like, which asset classes you like.
Well, what is cheap is Nigeria. It's very cheap market. Stock valuations are extremely low. I also happen to believe that South Africa is, the conditions are very bad. There's no question about this. But equally, the currency has been weak and stocks have been very weak. And so you can buy actually South African mining companies at very low valuations. Extremely low valuations. They may not work out for the next 6 months or so, but in general, I think that governments will come around to see that they actually need foreigners to run some of these companies, and that they have to obviously honor the ownership rights of some of these companies. So I would have some exposure to South African gold mining stocks. But whatever I say, I want your viewers to perfectly understand. I run a widely diversified portfolio of different assets in different geographical sovereign states. And so when I say I own some South African gold mines, it may not be very much, but in general, I have 25% of my assets in equities. I'm not bullish about equities, but I still have them. I have 25% in bonds and cash. And at the moment, the cash component is higher than it normally is. But I may shift around, because just recently, Howard Marks published an article that for the first time in years, bondholders, high-yield bond owners, will be able to achieve returns that are equal or better, or at least as good as stockholders. So for that reason, but not because I've just read it, but I had some bonds, and 3, I have precious metals, and of course, real estate. But I'm not very optimistic about real estate, whereby in Asia, we still have the process of urbanization that is taking place, especially in India. And we have, in general, I'm not saying everywhere, but in general, we have growing populations. Not in China. China's population, according to the official statistics of organizations that I would not regard as very reliable, like the UN and universities, but according to various sources, the population will decline by close to 50% over the next 30, 40 years. If that happens, forget about the Chinese economy growing at 6-8% per annum. They may not grow at all, and the property market may have made a long-term high and may never recover to the previous fantasy valuations that we had 3 years ago.
Oh, very, very interesting. And your thoughts, Ira?
You know what it reflects, in which I've, as long as I've read Dr. Faber, and it's what you have to respect, but I come from that school of thought. So it's a global issue, and you search out the things global. I mean, last time Dr. Faber and I, we not only talked about Asian banks, which we didn't talk about at all this time, but he was bullish, I think, on some banks in Singapore, but everything was with a global perspective. And you know, I laugh at Luke Roman, who I like reading. I have a lot of respect for him, and he had this comment a while back, maybe 2-3 months back, that the rarest commodity on Wall Street is a history book, and I think that's exactly right. And Dr. Faber is a walking history book, because he looks and he's telling you what he's reading. He's going back to look, because as in Ecclesiastes, what do they say? There's nothing new under the sun. And that's true. So we want to understand things. So everything that Dr. Faber talks about, and I love on Africa, because if you ask most Americans who are so concerned about everything, you know, with their virtual signaling, they don't know anything going on in Africa. They don't understand that China has a major naval base in Djibouti. They couldn't even find Djibouti. That the amount of violence in the Horn of Africa with the Tigray in Ethiopia, and we don't pay attention to it. And then when Yellen has the audacity, and I mean the audacity, to say, well, we can easily fund 2 wars, it's not talking about everything else that is burning in the world. And Putin sits there laughing, because he can stoke and create havoc. He can wreak havoc wherever he wants. The same with the Iranians. They're very good at it. And they have groups who are able to do it. And Putin's laughing right now. Okay, where else do you want to get yourself involved in? Okay, we need to pay attention to it, but it doesn't mean that there's not, of course, investment opportunities. And that's what we seek out. So yes, I'm still long my grain stocks. I'm still long mining stocks. I think Dr. Faber and I both loved Glencore and Freeport, and they've done, you know, but again, they don't run crazy. If you're looking for AMC, that's not AMC. Are they good, solid companies? The worst part about some of these companies, the mining companies especially, and they're like telecoms. When they have too much revenue, they wind up doing stupid things. When they're making too much money, that's why you always have to look at what their debt load is before you indulge into them. And my last caveat that I would say to people, if you're bullish bonds, you really have to be concerned that I'm looking right now. There is so much uncertainty in the world, and the bonds, global bonds, and we haven't even gotten into Europe. I hope we can come back soon, because I think we need to have a deep discussion on Europe. The European bond market also cannot get any bid to it. So if I'm long bonds, you can sit there, but as a trader, I go, where's the bid? Where's the bid? During times of great uncertainty, and this is great uncertainty. Even yesterday with the news, the news released by the New York Times, which turned out to be totally false, the bonds never went bid. They were offered all day long. Now people will say, well, they're offered because the retail sales number in the US yesterday was so robust. I'd call BS on that too, because as Dr. Faber says, who's getting hurt here? If you're living by borrowing money on your credit card and the cost of that debt is going up, you are on a very short string. And if the Treasury, US Treasury, and the Fed doesn't understand that, they all need to be replaced. And we haven't even seen the politics yet play take place at the Fed. And this is a whole other issue. So if we go back to talk about Europe and the Fed, because don't forget, Biden has 4 governors that are appointed sitting at that Fed who are all labor economists. And his head of economics is Lael Brainerd, also from the realm of labor economists. So how long can they sit there and keep pushing that 2% inflation mantra? How high will unemployment go, the real unemployment go, before they start going, no, we got to, I'm not talking about cutting rates, but we got to end this ridiculous discussions that take place on a daily basis from people on the Fed. And I would say, because I'm very concerned, and I'll end with this, on fiscal dominance, the Fed is losing $130 billion this year. Now, I know what the Fed will say. It doesn't matter. We've made money the previous 10 years and we sent it to the Treasury. So if we lose $130 billion this year, let's smooth it out. We broke even over the last period, except that nobody in Congress didn't save that money. If they were running surpluses, I would say yes, but they've been spending it beyond belief. So the Fed is going to have to cut the interest on excess reserves. They're going to have to. There's no way around it. And interestingly, the regional presidents don't vote on that. It's only the governors who vote, just like on the discount rate. The regional presidents don't vote on that. It is the Fed governors. And Powell is going to have to hold those people, because Powell, his main concern is having a unanimous vote at every FOMC meeting. How long will he be able to sustain that? And then what message will that send to the markets? And I'll shut up.
That's great, insightful discussion. Dr. Faber, how can our listeners and viewers learn more about your work, about your report?
Well, I have a website, www.gloom-boom-doom. I repeat, gloom, boom, doom, all in one word. And there's some information. But I'm not in the advertising business. It's very nice to talk to you and so forth. Yes. You don't need to push my work.
Thank you. And
very kind of you.
Yeah.
Okay, bye-bye. I have to run.
Dr. Faber.
Because the night is short.
Okay. All right. Thank you so much.
Bye-bye, Ira.
Thank you.
Take care.
I look forward to doing this again. We got to cover Europe. I know you got a lot to say about Europe.
Yes.
Yeah.
Okay, great.
Thanks, Richard.
Thank you.
Bye-bye.
Yeah.
Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.